Welcome back to another video. My name is Kyle and I suck at budgeting. We are on, I'm going to stop numbering them because I can never remember what number we're on. But we are on the stock market one.
We
right?
are, correct.
I did it. So Charlotte's here again. How are you?
I am quite delightful today. How are you?
Awesome. I'm fabulous.
Love it. Oh, do you want me to start?
Sure, go for it. I thought you were starting.
All right, so in our previous episodes, we have been talking about saving and investing. And we went through compound interest and just how investing your money is a great way to grow it as opposed to just saving it. Mm-hmm. So today we're going to be talking about the stock market. And it's a topic that seems to be very confusing for people. So we'll do our best. Again, we're doing a high-level overview of things. But of course, I'm going to start with a quote.
Yay, quote.
So my quote today is, it says, "In just about every way possible, we are wired the wrong way to be good long-term investors." Mm-hmm. And the person who said that quote is Daniel Crosby, who is a behavioral finance expert. And here's what it reminds me of. So I'm sure you remember this episode of Seinfeld, Kyle, where
I've never seen Seinfeld.
where George decided that everything that he did was wrong.
Yep.
So what did he do instead?
The opposite.
The opposite. So I thought of that when I read this quote, because that is the case. The things that we innately feel like are the right thing to do when it comes to investing are pretty much all wrong.
Right.
So we're going to try to teach you the opposite.
So instead of tuna salad on toast, chicken salad
on rye. Yes.
Even though salmon swims against the current while tuna swims with the current.
Good for the tuna.
Yes.
Never seen Seinfeld before.
It's amazing that you could just imagine that's what the episode was about. So, all right. So as a reminder, when we talked last week about investment accounts, so we talked about things like 401ks and IRAs and brokerage accounts, it's very important that once you open an account like that, that you invest the money inside that account. Right. And we mentioned that last time, and I'm mentioning it again because it is critical. All of the things that we're going to talk about in the next few episodes can be held within any of those accounts. So the 401k itself is not the investment. It is just the vehicle, the account, that holds the investments inside of it. Make sense?
Makes sense so far.
All right. So what we're going to do is I'm going to start with two things that people always tell me when I start to talk to them about the stock market. They have two concerns. Mm-hmm. So one concern is that they think the stock market is just gambling. Mm-hmm. And the other concern is that they say it's too risky and they are going to lose all their money. So at the end of this episode today, we're going to circle back and revisit those two and see if we can debunk them.
Sounds good.
To start off, the stock market itself is just a way that people and entities and companies can buy and sell parts of publicly traded companies. Now, some companies are not publicly traded, which means they are privately owned. Mm-hmm. And there are a few that we know, like Hobby Lobby, Wegmans, Wawa. These are companies that you, as a private investor, or I don't know if private investor is the right word, but we cannot participate in them. They have their own investors. But most of the companies that we deal with out in the world are publicly traded, which means we can buy and sell them on a stock market. So there are two major stock markets here in the United States. So we have the New York Stock Exchange and we have the NASDAQ. And I should have said we have two stock exchanges. So the stock market is the entity as a whole, and then there's individual stock markets within it. And other countries have, stock exchanges. I'm going to get my verbiage right here. So other countries also have different stock exchanges as well. So it's kind of like a supply and demand auction kind of situation where I can say I'm willing to buy something for a certain price. Somebody else can say I'm willing to sell it for a certain price. And we have to kind of figure out that whole supply and demand thing and come up with a price that we agree on. So reach back there into your old high school economics classes to try to make that make sense. Good?
Yep.
All right.
What does NASDAQ stand for?
I knew you were going to ask me that. Oh,
Is it North American Stock?
Automated quotation thing. It tends to be the tech-heavy one.
Okay.
Most of the tech companies, not all, but most of the tech companies are housed on the NASDAQ, with some exceptions. And it came about because the New York Stock Exchange actually has a physical location, right? You remember the old pictures of them on
Ringing the bell?
Yeah, the ringing the bell. They're on the trading floor. They're yelling. They're haggling. They're pushing papers
really
back
long
and
paper.
forth.
Yeah.
So the NASDAQ came about as an electronic-only stock exchange. So there's no physical location for the NASDAQ.
Okay.
But it has such a silly name, and I never remember what it is. So,
I'm just curious. I'll tell you what I'll do is I'll look it up and I'll put it down
Terrific.
across the screen or something.
Terrific. Thank you.
You're welcome.
So one of the things that you can buy or sell on these stock exchanges is something called stock. So stock is just a little piece of ownership in a company. So it's also called equities. And I liken it to the situation with your house, right? So you own a house, you owe some money to a mortgage company. So you own part of your house, and the mortgage company owns part of your house. Right. So the part that you own is your equity in the house. So it's the same thing with a stock. The little part that you own of that stock is your equity in that company. So each stock is sold in something called a share, and it just is that little representation of the little bit that you own, and every share has a share price. I point this out to say that the share price is largely irrelevant to the value of the company or the value of the stock. So some people will say, well, this stock share price is $200, whereas this stock share price is $100, so the $200 one has to be better. That's not the case. It's a little beyond the scope of what we're doing here today, but just know that the share price should not influence your decision about whether to get that stock or not. It's really just a function of how many shares they have and their total equity and all that other good stuff.
Okay.
So usually you can even buy fractional shares, like a little tiny piece of a share. You didn't used to be able to do that, but now you can. So that just makes it easier. If you wanted to buy a stock that was $200 and you didn't have $200 and you only had $50, you could buy a quarter of a share. So why do companies sell parts of their company to investors? It's usually because they're trying to raise money and they want to do it without debt. So maybe they want to open new stores, maybe they want to start new product lines. So they decide to sell little bits of their company to investors. And this way they don't have to pay you back, right? As a little tiny part owner of that stock, you get to participate in whatever the profit or loss of that business is. So if that business goes up in price, up in value, my stock goes up. And if they go down in value, my stock goes down. So there is some risk there because we have to make sure that we're investing wisely so that our money generally goes up instead of going down. This is considered to be fairly high risk. When people say that they look at the stock market as gambling, sometimes when you are putting your money into a single stock, that certainly can be considered gambling. Because along the way, we have had companies that completely go out of business. They go bankrupt, and that stock goes to zero. So there's a few out there that we're going to go through, but when we sit and look at the companies of today, right, the Amazons and the Netflixes and the Nvidias, we can't really imagine them ever going out of business.
Right.
But there were companies along the way that people felt that same way about, and now they're out of business.
Yep.
So I have a list here of a few. We've got Sears, we've got Toys R Us, Borders, Polaroid, Blockbuster, Lehman Brothers, Enron, Washington Mutual Bank, Circuit City, Bed Bath & Beyond, and most recently, FTX Trading and Spirit Airlines. We're right, that just happened.
Yep.
So anytime that you are investing in a single stock, you're taking on a significant risk there. The name of the game here usually is diversification. And we're going to talk about diversification instead of having everything in one thing about how to diversify. So the other thing to know about stocks, individual company stocks, is that small companies tend to have big movement and big companies tend to have small movement. So if we're looking at an old dinosaur company like Coca-Cola, their stock is not going crazy up and down all the time. They're a pretty standard thing. But if you have a brand new startup that is on the scene, they can have wild swings in there. So just something to keep in mind about stocks. Next up, we have bonds. So bonds are considered a fixed income. So we had equities for stocks, bonds are fixed income, and they are a loan. And it's a loan to either a company or a government, depending on what kind of bond that you get. And why do companies offer bonds? Well, again, they want to raise money. But in this case, they don't want to give up ownership of their company. They would rather loan you the money. You don't get any of the profits or anything like that, but they'll pay you back the money with interest. And often they can do that more cheaply that way than trying to borrow money from a bank. So that's one way that the bonds work. Now, there's interest rates on bonds, which are complicated, and we won't get into it too much. But in general, government bonds are considered fairly safe, where you're rarely ever going to lose your money in a government bond. But the return on the government bond is lower. It's that whole risk-reward teeter-totter. Do you say teeter-totter or do you say seesaw?
Depends.
Okay. Which would you say?
In this case, teeter-totter.
Okay. So it's that whole risk-reward teeter-totter, right? So the more risk you're willing to take, the more reward that you can get, and vice versa. So when you're looking at bonds with individual companies, there's a whole range. So if we use our example before, if I'm doing a bond with Coca-Cola, well, then it's probably going to be a fairly low rate, but it's going to be fairly risk-free. Whereas if I do a bond with a brand new startup company, well, they might give me a high rate because the risk is greater that they may go bankrupt.
Right.
Because in either of these cases, whether you are purchasing stock or purchasing bonds, if that company goes out of business, you're out of luck. Next up, we have something called mutual funds. So instead of buying individual stocks and individual bonds, you can buy something called a mutual fund. And that's basically where a whole bunch of people have gotten together and put their money in mutually. And they put it into a fund. So instead of just a single stock, a fund is something that contains multiple stocks or multiple bonds or a mix of both. So there can be, you can either do mutual funds or you can have something called an ETF, which is an exchange traded fund. And they're similar enough that we're going to group them together today. There are differences in there, though. The problem with this is most mutual funds and ETFs are actively managed, which means there is somebody sitting in a big office somewhere getting paid a lot of money to decide when to buy and sell things, how much to buy, and all of that other stuff. So there are fees that go along with this. So in general, when you have...
Fees are bad.
Fees are bad, and fees really matter.
I don't know a lot, but I know fees are bad.
So they typically have higher fees when they're actively managed accounts. In addition, which we'll talk about in a later episode, they typically underperform the general stock market as a whole, mostly because the fees eat into the profits a lot in terms of what you receive. So even if the fund does as well as the stock market does, once the fees come out, then you're behind. Now, most people say, oh, well, this guy who's managing this account, he knows what he's doing. He's going to make more than the market. There's some kind of stat out there, like 90% of the time in a 5-year period, they underperform the stock market. There's another option, though. The other option are called index funds, and that is a passive fund instead of an active fund. So for an index fund, no person is sitting in an office somewhere deciding what to happen. My best explanation of an index fund is this. So I used to teach first grade, and I would teach kids about the index in the back of the book. So when you flip to the back of the book in the index, it shows you everything that's in that book so that you know what's in there. So an index is the same kind of thing. It has everything that is in a certain category. So some of the indexes that you may have heard of are the S&P 500 or the NASDAQ Composite or the Dow Jones. Pretty famous indexes out there. So with the S&P 500, it has the 500 largest companies in the United States in there. So index fund. Because they are passively managed, they tend to have very low fees. And we like low fees. And so it's a good thing to consider. The other thing about index funds is that they are cap weighted. So it's just a fancy word for saying it's based on the size of the company. So when we look at the S&P 500, the largest company in the S&P 500 right now is NVIDIA at almost 8% as of the recording of this episode. So that is going to be a larger part of the index fund than, let's say, the Campbell's Soup Company, that is almost number 500 on the list, that has 0.01% of there. So the way that it works is that cap weightedness is based on a computer, right? They run the calculations and they decide how much should be in there. So we don't have to pay anybody to do it.
Cool.
Another option is something called a target date fund. So target date funds are found very often in workplace plans. It used to be back in the day that when you put money into like your 401k, it just went in as cash. And some people never invested it, like we were talking about before. So now a new law has passed and they have to invest it automatically for you initially. And usually the default is a target date fund. And it's based on when you plan to retire. And it's a mix of stocks and bonds and international and everything like that. And it will adjust as you get closer to retire. It becomes more conservative. So these are a pretty decent option if you can find one that's a reasonable price. Some of them have outrageous prices in terms of fees, and others are pretty reasonable.
Yeah, I remember when I was looking at all this, what was it, 2 years ago maybe? I was in a target date fund.
Yes.
And then I moved over to an index fund.
You did. I was going to ask you if you knew what you were invested in.
S&P 500.
There you go.
I don't remember what the fees were for the fees were for the target date fund, compared to what I'm in now. I have no idea, but I do remember that's what we did.
Well, in general, they tend to be somewhere like a 0.4 to 0.6 usually, whereas your S&P fund that you're in is probably 0.04. So quite a bit less. And I know those numbers sound like so small that they're meaningless, but they actually do, again, with the compounding, right?
Right.
And we'll take a look at that too. So, yep. So, Kyle, I'm glad to know that you know that you're in the S&P 500. Fabulous. Okay, so if we look back at these misconceptions that we talked about, the first one was the stock market is just a form of gambling. So we really want to approach this without a get-rich-quick kind of mentality here. If you are making purchases, especially if you're doing something diversified, like the S&P 500 is naturally diversified because it goes over many different sectors of the market, like technology and healthcare and energy and all those other things. That type of investment is going to track what the economy is doing. So the chances of it being like, oh, I'm just speculating and I'm picking some random one stock, it's not the same as that. So when we talk about gambling in the stock market, I'm going to give you a list of a few things here that I probably wouldn't recommend. But let me ask you a question, Kyle.
Okay.
Since the last time we spoke,
Yes.
Have you become a financial advisor?
I have not.
Okay, me neither. So we are not financial advisors. This is not financial advice. Don't take it that way. We're just trying to give you some warnings of things that might be a little dicey. Mm-hmm. So one is having all your money in single stocks. A lot of times people say they do want to have some money in single stocks, but most of the time they'll put it in something a little bit more diversified, like an index fund. Here's what we would recommend against: short selling, trading on margin, borrowing money to invest, day trading, options, penny stocks, leverage funds, chasing hot stock tips. All of those things, which we will not go into here, are what I would consider to be on that gambling side, because you can quickly lose money in a catastrophic way. Now, a lot of times people say to me, what about crypto? Now, crypto, what you want to do, but a lot of times right now, crypto is still considered to be pretty much gambling and pretty much speculative. Part of the reason is it's intangible, right? It's not like the rest of the companies on the stock market where they have goods or they have services that they're selling. And a lot of people look back and say, oh, well, look what Bitcoin did. Sure. There's a whole trail of cryptocurrency companies that bit the dust, and you just never know. So what I would say is that, we're not telling you what to do. If anybody's interested in investing in cryptocurrency, I usually give the opinion that it should be a small portion of your portfolio.
Yep.
The other thing was, it's way too risky and I'm going to lose all my money. Well, again, with the diversification, that should not be a problem, because if you are invested in the top 500 companies here in the United States, even if there are some that run into a problem, you have the other 400 something that are still going to be trucking along and helping you out with that. So if you were to invest in only single stocks, yes, you could lose all your money. That absolutely has happened. In that list of companies that we went through that went bankrupt, their stockholders have zero now in that stock. I like to use the example of NVIDIA. So over the last 3 years, NVIDIA is up 600%. Now, when we were doing our compound interest calculator, we were doing it on 8% a year. I mean, imagine this is like an annualized 200% every year.
Yep.
These numbers have exploded. And what happens is, in hindsight, people go, well, I'm just going to pick the next NVIDIA, right? Like that's what I'm going to do. But there were so many other tech companies that came up and either failed or are doing miserably. So trying to pick stocks like this is very complicated. And most people are very worse off for having done it. I actually have a friend who I was talking to the other day, and we were saying something about the stock market. And he said, oh, well, I never recovered after the 2007 crash of the stock market. And I was like, what? How could that be? Because when we look at the stock market charts in the next episode, you'll see, like, how is it possible? Well, it's because he was in one stock. And then that stock never recovered. So, whereas mine is up many, many times.
Yep.
So the resource that I have for you guys today is one of my favorite books. Again, it's one I have purchased, and it's called The Simple Path to Wealth by J.L. Collins. JL has a website. So it's jlcollinsnh, like New Hampshire.com. And he says that everything that is in this book is on his blog on that website. What are you?
Tell me what the NH is.
New Hampshire.
No, it's not for New Hampshire.
It is for New Hampshire.
Really?
Yes, he lives in New Hampshire. He's a boomer. He didn't really have an exciting way to name his website. So, you do not have to purchase the book, but this book has a few great chapters in it. You can borrow it from the library. He does tons of podcasts. And one of my favorite chapters in here is why I can't pick winning stocks and why you can't either. He's very realistic, and he is a big proponent of index funds. All right. So I already asked you my question, Kyle, about did you know what you were invested in? So I'm impressed that you knew. So that's my question to your viewers today. Do you guys know what you're invested in? Most of the time when I start trying to help people, they are clueless.
And I had no idea.
Well, the first step is to figuring out what you're invested in. Yep. When I was first figuring this out and I found out what I was invested in and I changed my my investments at that point, it made a dramatic difference in my long-term results. And I know that's one of the things I did with Kyle is that we ran some what they call a back test portfolio where you can kind of see what your portfolio did and what you would have done if you were, let's say, in index funds or something like that. And I think that's really what finally convinced you to switch away on some of those things. So, all right. Next time when we get together, we're going to be covering the stock market fluctuations, stock market history, so we can understand the ups and downs that happen in the stock market.
Cool. So before we go, I want to, just because that made me think of this, so I'm just going to bring up my YNAB real quick.
Great.
So this is, my Vanguard account is the account that we changed from, I don't know what it was invested in when it was not Vanguard, but what I did was I started tracking this inside of YNAB. So right here for December of 2024, this is where I switched to Vanguard, and you can see how the numbers have changed rather drastically. So I was averaging what? I mean, was it $600 or so before, and now I'm over 1,000 more often than not, with the exception of the few dips that we've taken. But my returns have been bigger with my switch over to Vanguard with that index fund. So
now I would caution that there is also the actual stock market to be considered as well, right? Mm-hmm. Because sometimes people switch over and it just happens to be that's right. When the stock market goes up or that's when the stock market goes down. But certainly if we were to look back, I know that based on what you were invested in before, you are well ahead now than what you would have been before. And a lot of people, they kind of guess, right? They say, oh, you know what? My stocks are doing great. Well, but quantitatively, how are they doing? How are they doing compared to what the actual stock market is doing? So that's kind of the things that Kyle and I have done along the way to make sure that we are making decisions for both of us based on math and actual numbers instead of just a feeling.
So then just a diversification question. So as of now, I'm invested, all of my stuff is in that S&P 500 index fund.
Right.
Would you say that I am diversified enough since all of those companies are U.S.-based companies? Should I be investing in foreign companies as well?
Excellent question. So I can't tell you what to do.
Right, but I mean...
Yes.
Now, this is something that you've kind of mentioned to me, so it's...
Yes.
As the world changes, that's something that we should be thinking about too.
Yes. So there was a blog post the other day from J.L. Collins, who said that he is starting to now diversify into... instead of a total U.S. stock fund, a total world stock fund for some of his holdings. And I have not done this yet, but it's something that I am considering along the way. If that is something that is appealing to you, the best place to start to do things like that are in your retirement accounts. So all of your money is invested in retirement accounts. And you can change how you are invested in those accounts without any tax considerations. Now, I don't want to tell people to start jumping in and out and changing things constantly.
Right.
But if at some point anybody feels like I need to have a different diversification, as long as you were kind of sticking with index funds, whether it's a total world or the U.S., I think you have to go with your gut on that.
And I could be wrong, but it's been a long time since I've listened to Ramsey, but he was 25, 25, 25, 25. 25 was international, and then was it 25 bonds?
Oh, no bonds. No. So
What was he?
25% growth,
Yep.
25% growth in income, 25% aggressive growth,
Okay.
and 25% international.
Yeah, I knew it was,
so,
there were four, and they were all equal.
yeah, so the aggressive growth is like small cap, small companies, and the growth and income are the large companies, and then the international. Now, not to get off on a tangent, but for about, I don't know, 10, 15, 20 years, whatever, international's been in the toilet, right? It hasn't been doing a whole lot.
Right.
Now, the last 2 years, this is 2026 right now, the last 2 years, it's been on fire.
Yep.
We don't know what's going to happen.
Right.
And some people like to have that international in their portfolio. For sure.
So, okay.
All right, so next up, stock market fluctuations in history.
Thank you so much for watching. We'll see you then. See ya.